how you can ask questions. I think some of you have already figured that out. There's a Q&A or chat box at the bottom of your screen. So please feel free to click there and type in any questions you may have as we go through today's presentation. Also, if you'd like to follow up afterwards, we definitely welcome any emails or calls that we can schedule to hop on to help answer any additional questions. So without further ado, I'm going to turn it back over here to Al.
All right, we'll try this again. I sounded really good for a few minutes before. Thank you for joining us. This is Al Badaback, and I'm here today with Jason Dahl. Some of you may not know this about me, but my first career was as a CPA, and I focused entirely on preparing individual taxes. I want to point out that this is not the beginning of a comeback for me. I have no intention of entering the tax business again. When I look back on my life, the day I exited the tax business is possibly one of the happiest days of my life. Our title for today's presentation is It's Not Too Late, Tax and Charitable Giving Strategies Under the New Tax Law. Now we're click on the slide first. There you go. A few of the standard tax jokes. In the past, tax reform never meant simplification. However, the Tax Cuts and Jobs Act of 2018 did actually simplify things. The new tax law substantially increases the standard deduction, and as a result, millions of taxpayers will no longer be itemizing their deductions. Overall, while I am a big fan of the corporate tax changes, I dislike many of the changes in the new tax laws that affect individual taxpayers. A few facts on our tax system. The U.S. has a progressive tax system, meaning people with higher taxable incomes pay higher federal income taxes. Due to the Tax Cut and Jobs Act, the TCJA, the 2018 tax brackets, tax rates, and standard deduction amounts have all been revised. Taxpayers fall into one of 7 brackets, depending on their taxable income: 10%, 12%, 22%, 24%, 32%, 35%, or 37%. Tax rates will differ for long-term capital gains, qualified dividends, etc. For individuals, these lower rates are scheduled to expire in 2025. Let's compare the 2017 and 2018 tax brackets. In 2018, the first 4 tax brackets are very favorable to taxpayers. However, for single filers, you enter the 32% tax bracket at a substantially lower income than the 33% tax bracket in 2017. Also worth noting for single taxpayers is the 35% tax bracket starts at $200,000 in 2018 compared to $416,700 in 2017. Though it ends on a positive note with the top tax bracket in 2018 capped at 37% versus 39.6% in 2017. Additionally, the new law minimizes the marriage penalty for dual income high earners. That's a huge positive, a major change, always been a problem with past tax reform. So again, we were very happy to see that. Big changes to the standard deduction in 2018. You get a substantially higher standard deduction in 2018 compared to 2017, but you no longer get a personal exemption in 2018. So that's the trade-off. In 2018, if you file as a single taxpayer, your standard deduction is $12,000 compared to $6,350 in 2017. If you file married filing jointly, your standard deduction is now $24,000 versus $12,700 in 2017. Taxpayers 65 and older get a larger standard deduction. If you file as single and are 65 or older, you get an additional standard deduction of $1,600. A married couple, both age 65, will now get a $26,600 standard deduction. That's $24,000 plus an additional $2,600 for being 65 or older. Personal exemptions have been replaced with the child tax credit for dependents 16 and under, and the family tax credit for dependents 17 and older. Remember, a credit is a dollar for dollar offset of your taxes, much more valuable than a deduction. For the child tax credit, you get a $2,000 credit for each qualifying child. If you have 3 qualifying kids, that's a $6,000 tax credit. This is a huge tax break for taxpayers with qualifying children that are under the phase-out limits. The family tax credit gives taxpayers a $500 credit for qualifying dependents age 17 and older. The credits phase out above certain income levels depending on your filing status. We have the phase-out ranges for various filing statuses on the bottom of the page. You can see if you're filing as single, the credit will phase out between adjusted gross income of $200,000 to $240,000, and that term AGI, it's basically the front page of your Form 1040. There are a few big changes in itemized deductions. Today, we'll focus on taxes, mortgage interest expense, charitable contributions, and miscellaneous itemized deductions, the 4 main itemized deductions. One of the most controversial changes is the new $10,000 cap for deducting state and local taxes. This is a major change for taxpayers in high income tax states such as Maryland, DC, New York, California, Massachusetts, and New Jersey. I know there's some others, but those are the main ones. Previously, the deduction was unlimited. If you're a high income resident of a state without state taxes, such as Florida or Texas, the new tax law is a windfall for you. In our example, we show you a taxpayer that pays $12,000 in real estate taxes and $24,000 in state income taxes. In 2017, that taxpayer was able to deduct the full $36,000 paid, but in 2018, that same deduction is capped at a whopping $10,000. The next change makes no sense to us, especially when you consider that Trump is a real estate developer. I was really shocked to see this actually get through. The new law caps the amount of mortgage interest you can deduct for homes purchased after December 16, 2017. You can write the interest off on your first $750,000 of mortgage debt. The old law capped the deduction at $1 million of mortgage debt plus an extra $100,000 for a home equity line. You can still borrow a larger amount for a house, but your mortgage interest deduction will be capped. A change to the deductibility for home equity lines. Home equity lines are now deductible only if they're used to buy, build, or substantially improve your home that secures the loan. They are subject to the same $750,000 cap. For example, if you have a $650,000 mortgage on your home, you can only deduct the interest on the first $100,000 of a qualifying home equity line. They did grandfather in the old rules for homes purchased on or before December 16, 2017. So if you've got a $1 million mortgage for a house that you purchased before that date, you can still write off the mortgage interest as you did in the past. For charitable contributions, no real changes here. Basically, the same rules apply. A couple little tweaks that actually favored the taxpayer, but again, no real changes. Another major change, miscellaneous itemized deductions, eliminated for years 2018 through 2025. Essentially, all of your miscellaneous itemized deductions are eliminated for these years. This affects Schedule A only. It does not affect miscellaneous deductions or other deductions on Schedule C for businesses or on any type of business return or Schedule E for rental real estate. All those have stayed intact. As a result of these changes to itemized deductions, fewer people will itemize. The combination of the larger standard deduction the cap on the SALT deductions, and the elimination of miscellaneous itemized deductions will make it so many people will not itemize in 2018. In our example, we have a married couple with $22,500 of deductions. In 2018, with a $24,000 standard deduction for taxpayers married filing jointly, the taxpayers will no longer itemize because the standard deduction is larger than the total of their itemized deductions. Under the new tax law, if your house is paid off or you have a small mortgage, there is a good chance you will not itemize unless you have a substantial amount of charitable contributions or a large amount of deductible medical expenses. The fallout from all this, we expected this to happen, and it is. It's what I call a giant sucking sound down to Florida, and you could probably say Texas too, where there are no state income taxes. A relatively small number of wealthy families blew a nearly $80 million hole in Montgomery County, Maryland's budget by legally changing their state of residency. High-income taxpayers are moving away from the high-income tax states because of the $10,000 cap on the SALT deduction. In my opinion, this one law change will significantly reduce tax revenues in the high-income tax states. Keep in mind, this is the first year of the change, and it's already impacted budgets. Here's a tax planning strategy called bundling. Bundling deductions is the process of lumping payments you would make over multiple years into one tax year. Bundling deductions will potentially allow you to itemize your deductions in certain tax years. We are primarily seeing this used with charitable contributions, but the same concept can be used for taxpayers with a substantial amount of deductible medical expenses. But as you know, on medical expenses, you have to get over a threshold. For 2018, your medical expenses have to exceed 7.5% of your adjusted gross income before you can even begin to itemize them. We have a great example on the next slide. This is a married couple that normally has $23,000 of itemized deductions, of which $10,000 are charitable contributions. Under option 1 on the left side, you see that they get the standard deduction in 2018 and 2019 because their itemized deductions are less than the $24,000 standard deduction. They made one change in option number 2. Instead of giving $10,000 to charity in each year, they gave $20,000 in 2018 and $0 in 2019. In our example, they now have $33,000 of itemized deductions in 2018, and they take the $24,000 standard deduction in 2019. This simple move allowed them to increase their deductions by $9,000 over the 2 years. You can see they get a total of $57,000 of deductions in option 2 versus $48,000 in option 1. Another tax planning strategy to consider is to donate appreciated securities instead of cash. Now, we've actually done this a lot in the past. Let's say you own 100 shares of XYZ company stock worth $10,000 with a tax basis of $2,500, and you normally make a $10,000 charitable contribution to your alumni association each year. Instead of sending them a check, consider donating your 100 shares of XYZ company to your charity. You still get a $10,000 deduction on your taxes as long as you itemize, but you never had to pay tax on the appreciation of your shares. Most charities are aware of this tax strategy and are set up to receive gifts of appreciated securities. Now, this applies to your personal accounts. You can't make gifts of appreciated securities out of your retirement accounts. One thing to keep in mind, the shares you donate have to be held for over 1 year. Another tax planning strategy to consider is the use of a donor-advised fund. Think of the Bill and Melinda Gates Foundation. They essentially donated their zero basis shares of Microsoft to their own foundation and received a tax deduction for the donation. Today, through the use of a donor-advised fund, many people are setting up what is basically their own personal foundation to help facilitate their charitable endeavors. Very easy to set up. We've probably set up a dozen or so over the past 6 months to a year. You donate appreciated securities or cash to the donor advised fund and claim a tax deduction for the year that you make the donation to the donor advised fund. This is a great vehicle to consider if you are bundling your charitable contributions or if you are trying to reduce your tax burden in a high tax year. You then make donations from your donor advised fund to your qualified charities whenever you want to make them. Remember, you already got a tax deduction when you funded your donor advised fund, so you do not get another deduction when you make the donations from your donor advised funds. Here's a summary of the advantages of using a donor advised fund. Planned gifts can be made in the tax year when they are most advantageous. Grants to charity can be made at the donor's convenience. Administration and record keeping are handled by the DAF. No paperwork on your part, basically. Convenience of online and mobile accessibility. And it really is a great way to donate appreciated assets. We've had a number of people that have held stocks like Verizon or Exxon for 30 or 40 years, and they really don't even know what the tax basis is for those securities. And it's actually been a nice way to kind of get rid of that accounting headache. They actually just donate the shares into their donor advised fund and take a deduction for the fair market value. One last tax planning strategy to consider if you are taking RMDs, which are required minimum distributions from your retirement accounts. You can essentially donate all or a portion of your RMD directly to a charity. Your donated RMD is not considered taxable income to you, and you do not get to claim a charitable contribution for the donation. That actually all makes perfect sense. This is a great strategy to consider if you like to give to charity and you do not itemize deductions. So we've seen this happen a lot of times this past year where people have taken a portion of their RMD and have actually donated straight to the charity of their choice. And it's really beneficial, as I said, if you're not really going to be itemizing on your taxes. Our main takeaways. The rules have changed, and most people are unaware how the changes will affect their tax return. The larger standard deduction, combined with the SALT limitations, will result in fewer people itemizing. Consider bundling deductions if you'll benefit from the strategy. This is a big one. If possible, prepare your returns early this year to avoid a last-minute filing shock. We're big believers that a lot of people really haven't looked into this, and they might be surprised that, if they're a high-income taxpayer and they pay a lot of state and local income taxes, that deduction is going to be, substantially capped in 2018. Probably the best advice we can give is consult your tax advisor. As I mentioned, I'm a retired CPA, so I consider myself rusty, but I actually really enjoyed this exercise of just kind of going through the tax law and see what the changes are. Any questions that came in?
Sure. Yes, we had a couple questions come in. So first, Al, maybe you could just, I know there's a lot to the AMT, but maybe you could just comment a little bit on the new tax law and how that may alter folks' alternative minimum tax.
So the AMT, the alt min tax, is probably one of the more complicated tax items on a tax return. But generally, what would cause the AMT is if somebody actually deducted a large amount of state income taxes. And so the reality is the state income taxes were reversed out in the AMT calculation, and you generally paid this thing called the alt min tax. So essentially, you lost the benefit of paying your state income taxes. So more than likely, most people that were subjected to the AMT in prior years, they won't be paying it in 2018 because they're not going to be deducting more than $10,000 of state and local income taxes. So indirectly, that kind of helped eliminate the AMT.
Great, thank you. And then there was one other question. I think I can address this with, how do I find out if a charity accepts stocks or appreciated securities? So that is just simply a matter of contacting your charity of choice. A lot of times directly on their website, they will have the option that they will provide the instructions right there on their website for a lot of charities. And if not, you can just contact them, give them a call, shoot them an email, and they will provide to you their brokerage account information, so that then you can submit to your advisor to transfer the appreciated securities.
Essentially, the securities we always use the term, get pushed out of the account to the charity. Very straightforward.
And we've had a couple of people ask about a copy of the presentation. So we can definitely make a copy of the presentation available. We'll make the full audio and video recording available, as well as if folks just want to have the slides themselves. We can certainly send those to folks if you just want to shoot us an email. And another question on how many months do I need to change state of residency? Is it too late to do it now?
So I'll answer that one. I'm going to say yes, it is too late to do it now. You, in theory, can change your state of residence. Say if you actually moved physically from Maryland to DC before the end of the year, you actually would file a part-year return on your taxes. But if you're trying to get to the States without state income taxes, you essentially would still be subjected to tax on your state of residency. For example, let's say you moved 11 months into the year. In the state of Maryland, Maryland would tax you on 11 months of your income for 2018. They wouldn't tax you on the last month after you've moved out of the state. And some of these states require you to meet certain considerations before you become a resident of the state. I think in the state of Florida, they want you to be down there for 6 months before they consider you a resident. And one of the things to keep in mind, it's not as simple as actually just saying I'm changing my driver's license and licensing or re-registering your cars down there. You actually have to move, and usually you have to spend more than 6 months of the year out of the state that you're trying to get out of. So, for example, these people that were leaving Montgomery County, Maryland, they quite possibly had winter homes down in Florida, and they might have been spending 4 or 5 months of the year down there. In those situations, what they probably did is actually just modify their behavior a little bit, and now they're spending more than 6 months of the year outside of the state of Maryland.
Yeah, thanks, Alp. I mean, I think you addressed there was an add-on to that question of what if I have a second home in Delaware or Florida, and I think you just addressed that to the point of, folks have that second home and they were already spending time at that second home. The key really is about the time out of the home state, the state of Maryland in the example you
Correct. Gave. And if you're still working, if you actually are trying to relocate to Delaware, Delaware actually still has a state income tax. It's lower than Maryland and DC and some of the higher state income taxes. I think it's probably very comparable to Virginia's taxes. And again, I'm a little rusty on the specific tax rates of the states. What Delaware is generally famous for is they don't have sales taxes.
And reasonable property taxes. Would you agree?
Yeah, they have much more reasonable property, without a doubt. Without a doubt.
Great. Another question or first comment, super helpful information. Thanks. Glad you like it. So the question is, would you trust TurboTax to handle all the changes appropriately? It doesn't help with strategy, but using auto pulling in of investment info and such works well enough, question. And so first I would say two points on the strategy side of things. The best way to kind of utilize a TurboTax or any other tax software for doing it yourself would be now, before the end of the year, to essentially run through and plug in your information, obviously without submitting the return, but just kind of do a pro forma where you plug in the info and see the impact on the tax. And then you can say, oh, well, what if I double up or bundle to the strategy that we spoke of earlier on the charitable giving. And so you could say, well, I was going to do 10,000, but now what if I did 20? And you can see the impact on the taxes. So that's kind of from the strategy side of things. You have to kind of prompt it yourself. But yes, on the other front, TurboTax does a great job of adding in the new tax laws into the software. You can utilize TurboTax to pull in data directly from your brokerage accounts to your investment accounts. I know that is definitely something that many of our clients use. And through our client portal, you can set up a link to be able to download all the tax information for that year. So that is definitely a good tool, and we highly recommend utilizing it.
And I'll say, as a CPA, I don't even know what they cost now, but we would be using professional tax packages that probably cost $20,000 that we would joke were essentially worthless on April 15th. But I actually now use TurboTax to actually file my own return, and I find it very good at what it does. But I'll say, as a professional, the only thing I don't like about it at times is kind of when you're rerunning the numbers, like rerunning through some of the screens, it kind of asks you some of the same questions. But other than that, I'm fine with the program.
And then I think one other question, Alf, if you go back to the qualified charitable distribution slide for a moment. Yeah, right here. I just wanted to add a comment that one of the added benefits potentially, so if you are subject to required minimum distributions and you are enrolled in Medicare, depending on your level of income, by sending your IRA distribution, your required minimum distribution, directly to a charity and not having it come in as income, that may be enough to keep you under the Medicare income thresholds that would result in a higher premium. So I'm sure some of you on the line may be familiar with this, but we've definitely seen instances where by taking the RMD, it pushed their income above the threshold that then in the subsequent year resulted in higher Medicare premiums. And so this is just another strategy of a way to potentially save on Medicare premiums by not taking receipt of the required minimum distribution, having it go directly to charity. So I think we've covered all the questions at the moment.
So let us know if you have any follow-up questions regarding any of the material we reviewed today. And we'll leave you with this. Enjoy the holiday season, and best wishes for a healthy and happy new year. Thank you.
All right, thanks, everyone.